We have been taught that a profit and loss statement is based upon accrual system of accounting, and the P&L statement can mislead you. But we have been also taught that a cash flow statement cannot mislead you. Here I'll make you understand that how a cash flow statement can mislead you as well. A cash flow statement is being divided into the cash flow from the operating activities, the cash flow from the investment activities, and the cash flow from the financing activities. The major focus should be from the cash flow from the operating activities. That is the actual cash flow that me as a business generate from the core activities of the business, buying and selling of goods and services. Of course, adjusted with the net changes in the working capital. Actual cash which my business generates. Cash flow from the investment activities is linked to those activities which pertains to my capex, purchase of plant, machinery, fixed assets. And the cash flow from the financing activities pertains to those activities where I take loan or pay off my debt, I pay dividends, I raise equity, get cash. Here I need to understand that we usually look at the net cash flow, that is the summation of the operating activities plus investing activities plus financing activities. And this total number can mislead you. So for example, if this number comes out to be 100 crores. So here we need to analyze that which component is contributing to this 100 crores. This 100 crores should majorly come from the cash flow from the operating activities. Because for example, if the business is selling off the fixed assets in the business, in that case also the cash flow from the investing activities will be positive. But here we need to open our eyes and ears and need to understand that why the business is selling off the fixed assets. Doesn't the business want to grow? The third reason why which this number can be positive is from the cash flow from the financing activities. If the business is raising excessive debt, enormous amount of debt, it's shown as a cash inflow in the business. And due to that, this number can still be positive. And hence, both CFI and CFF can mislead you. The only number that you have to focus upon is the cash flow from the operating activities. And for example, if the business generates a cash flow from the operating activities as 40 crores, and the cash flow and the investment expenditure, that is the capex the company wants to make, is 20 crores. It's very important to understand or compare the cash flow from the operating activities and the quantum of capex the company wants to do. If the quantum of capex is less, it clearly shows that the company is able to fund its capex by the cash flow from the operating activities. Though you will not find like many companies who tend to do that, because if this amount the CFO tends to fall short, they tend to raise money via debt, and hence the cash flow from the financing activities tends to rise. Hence, it's very important to understand that where this capex is getting funded from. Can my OCF fund it entirely or partially, or if I'm taking debt via the CFF, the cash flow from the financing activities, to fund my capex. And that is the reason you need to understand the whole cash flow statement via the OCF, ICF and FCF, and not just see the net cash flow number, which can manipulate you and make a fool out of you.